So today the markets played out according to the script that we talked about last night. Small down days continued within that range of that long lower shadow on the large cap indexes. That wasn't needed on the small cap because it already pulled back, so the small cap was more flat. Small ranges, really boring day, small volume. But we saw something today we haven't seen in a long time from a technical perspective, and that's going to impact our expectations. I'm going to show you what that is in today's video. Today's trade idea also takes advantage of a popular stock that's in the news to see how we can take risk away from one side of the trade and throw it to another where we're not so concerned about. I'm going to show you how to do that. Let's go ahead and get started. Today is Friday, November the 10th, 2017. This is the Market Outlook video. My name is David Settle. Thank you very much for watching today. Welcome to those that have found us, that are watching for the first time, or welcome back to those that maybe used to watch me on other videos. It's been a while. Welcome back here. I want you all to do two things for me. One, I want you to subscribe to the YouTube channel. Click that bell next to the subscribe button after you've done that to get notified when these videos are posted. I want you to click the thumbs up, let me know that you liked it right below the video, and then down further below, comment on anything you learned from the videos this week. I like to see kind of what stands out and what are some light bulb moments for you so I can keep educated in those areas. The second thing I want you to do, follow me on Twitter. Like today's tweet. You'll find it pinned to the top of my timeline. Like today's tweet, retweet it if you think you should. Other people should check it out. You do those two things, Twitter will start to promote it for you and for me, and get this word out to other people that I'm back and I'm in this new area and we're doing these videos again. All right, let's take a look at the S&P 500 with these indicators here, and we'll take a look. So we talked yesterday about to anticipate or expect. Not necessarily on the small cap index, but especially on the large cap index, because it hasn't pulled back as much as the Russell. But at least another day or two of weakness, of filling in this range right here. But remember that candle, the low of that candle will be support. Well, we got one more day. Now that day wasn't enough to get the near-term line down below the 50th percentile. So we might get another day, but again, there's going to be some support here. In fact, both these long lower shadows, the lows are right about the same level. So if we get another day, maybe down to the 50% retracement of the near-term run, that might be enough to get the near-term line below 50, and then we'll set up for a new bounce. Now, again, considering we're multiple months into this intermediate posture and how high, we're above 90 now on market sentiment. I mean, just for past precedent on how many times or what the market has done in the past when the market sentiment line gets above 90. So I'm going to set this value to 90. In fact, actually what I'm going to do is I'm going to come over here and move it so we can come all the way over here. All right, now let's set that price to 90. And you can see, we can go years and years and years. We went all the way through the middle of this decade without ever getting to 90 on market sentiment. So that just kind of shows you how bullish we are. You can see here we never did get above 90 in 2016, even though we got a little close. So here the last time we got up to 89 on market sentiment, and that was about the time that we peaked in February of 2011. So that's going to be like right in that area. You can see back over here we got close. We continue higher, formed some divergences there, but again didn't get to 90. We got to 89 there. So really, in the last 20 years, the only time market sentiment's ever been above 90 was right here in April of 1998. So again, just to kind of show you what we had to get to that point. Let's zoom out a little bit. We'll just kind of come right over here. Okay, to get to that point, you can see there's the move. It was a strong move, similar to what we got right now. We were coming up off of a low point of market sentiment that was in the 60s, high 60s. We took off for multiple months, February, March, into the beginning of April. Brought that market sentiment line above 90, so we would have crossed above. Let's see here. We'd have crossed above it right there. So that was the day that we crossed above it. We did go up to a new high a few weeks later, but you can see that was the end of the run, and that was the consolidation that we got since. Now you notice while it was pulling back, after a couple of months of consolidation, we did go up to a new high, and big time divergence there, and that led to a lot more weakness in August and September of 2008 from a technical standpoint. They again didn't change the long-term trend for too long, long lower shadows, and then boom, back up with market sentiment coming up off of a 25. So now you have a much better potential move here, and it took off at the end of 98 into 99. Of course, we all know, that's the year. I mean, 99, 98, 99, that's the year the market, especially the technology index sector, did really, really well. So I mean, for some perspective, that's what we got right now. Market sentiment's above 90, and it's not very often we get that. We got over here, we got up to 89, and you can see we took off to a new high while it was starting down, and then that led to some weakness here. But again, back to 90. And what kind of returns do we expect to see? Well, the one time in the last 20 years we saw that, we went on a multi-month sideways move. It wasn't a downward move. It wasn't this extreme overbought condition that led to a lot of selling. Nope. It was just a sideways move that just went up and down for a few months before we had that big push higher to a divergence high, and then a much more extended sell off at that point. So, and again, this different environment from a macro level in terms of what's driving stocks now versus then. So we can't say that's exactly going to happen that way now, but from a technical perspective, it shows just how many buyers have been in this market to get us to this point. And what happened before is you kind of ran out of buyers, and that's what led to the conditions that produced, in one instance, the big sideways action, and then after that last kind of blow off top, that more extended bearish intermediate run that brought that market sentiment all the way down, pretty much almost to the other reversal zone. So the Russell 2000 small cap index was the one that's already bearish out of all the indexes, and you can see it continues to be that case. It didn't have as big of a downward move today, a very small range, and again within the range of that long lower shadow. So it didn't, its near-term line was already below 50. The intermediate posture is already bearish, so we weren't expecting the same weakness. In fact, we're looking for that to bounce here. It just might not bounce as strongly because the broader market posture, which is overbought, mature, and expecting some near-term, at least near-term weakness. All right, so now the long-term view, you can see we got a red candle, first red candle on a weekly basis for the S&P 500 that we've had for a lot of weeks. And you take a look at some of the other major indexes, the Dow Jones, same kind of a thing, first red candle, but way up above its 50-day moving average. The Nasdaq Composite, which is not QQQ, remember, is the Nasdaq 100. It was not red. The Composite was more red because remember the Composite's got some small cap influence to it, so it was red. But again, look at that. MACD, if it's the 1500-day moving average, is as bullish as it can be, and of course the Russell 2000, not so much, and it's down closer, much bigger. It's had 3 red candles in a row, and is actually coming down to its 50-day moving average, and closed a little bit below that, according to that red arrow, closing below that 50-day moving average. In this case, it's a 10-week exponential moving average to try to make it a little bit more sensitive to recent moves on that chart. But again, it's the only one that's had 3, or even the other major indexes, their red candles are pretty much, spinning top doji type patterns. Here we actually have a couple weeks of pretty decent ranges, where we open and we close, including this week. So some weakness in the small cap index, and again, that can, be a prelude to some weakness in the broader market. If you take a look at the MACD and the stochastic indicators, back below the 8-day. So we talked about that too yesterday, right? That we might get another day or two where we might test the 17-day moving average, since we were kind of right at the 8-day yesterday. Well, that's what happened again. So now we're testing the 8-day, and you notice, look at the MACD, it's coming closer to 0. It's not quite there, and it doesn't happen. It's not quick. You usually don't. Doesn't mean it can't happen. But past precedent, we usually don't dive down below 0. We kind of grind our way down. So we'll probably go sideways here. We might even have another down day to that 50% Fibonacci come down below the 17 a little, but hold a 30, and then kind of bounce up and down while those lines continue to converge, and this MACD gets to 0. And you can see the stochastics and the MACD both forming divergences, which would put this 23% Fibonacci retracement, which is lining up with this low point here, which is corresponding to these lows here. That's where our target would be on any kind of intermediate trend. At least our first target would be based on that bearish divergence on both the MACD and the stochastic. All right, so the intraday chart shows how neutral today's candle was. So it was, obviously a little bit of a down day, and we did gap down, but we stayed easily within yesterday's range, also within last week's range. We haven't moved that 4-week high up. We were moving it up almost every day there for a while, or for a few days at least in a row. Now we've been down below that, and again, take a look at the 4-week range. We're not going to move that low point here for another week or so. And the gap is about 5 points. If we don't break up to up past 260 here, essentially, by in the next 10 days, then you're all of a sudden now our range is going to be about 3 points. So, and again, that's the kind of range you get right before you start to pull back more with a more extended move. So definitely we'll keep an eye out on that to see if we stay here for a while, or if we even start to come down into here and fill this in for a while, and trade in the lower end of this range. Otherwise, to avoid any bearishness, we need to kind of break out of these highs here and get back up to these levels closer to the 4-week high, because again, you can't break above the 4-week high until we get up to it. And so we're kind of trading down in the middle. And again, like I said before, don't be surprised if we don't get another day. We're kind of in here in this area before we set up for that potential buy and return back to the top end of this chart. From a trading range perspective, the volume really tapered off from yesterday, and the range did too. So it was 60 million. If I were to come over here, we'll get rid of that window there. 1 point's down below. 60 million is also a little bit down below. And again, those are the days that will bring these lines back down. That's what we want. It's boring, and there's not a whole lot we can do in terms of like speculative directional trades. But that's just not the market environment we're in right now. Volatility rose a little bit, and that's a good thing. It kind of got back up here, and again, the higher it gets, then it can come back down, and as it comes back down, that leads to the bounces that we want to see. And on the profit charts, it's not updated yet for the 3-month version, so you can see here the VIX is at 1129 on that chart. If I were to take a look at VIX 3 months, VIX 3 months, you can see it's up to 1361. So when you take a look at that, when you divide VIX into VIX 3M, you see it's 83. The VIX right now is 83%. Remember, the extreme low is 80, and the kind of sweet spots for bullish trends is 85. And, if we can hold that 85 level for a resistance, that would be great. If we were to get above that, then we might get more of that protracted weakness now rather than later. All right, now we take a look at what's driving the price action today. And remember, again, we were up. We started off down, and what really was down lower at the beginning of the day was long-term treasuries. So yields really took off today. The other things that were up at the morning, obviously crude oil continues to be strong. Small cap stocks started the morning strong. High yield started the morning strong. So those are the two that were impacted most negatively by these tax reform expectations, positively initially, and then more recently negatively. So you can see they kind of bounce up because remember, they're the ones that have been dropping the most. If I were to zoom out, you see they're the ones that are dropping the most here. So they bounced up today. Kind of a lack of news, nothing really going on. So they, kind of paired some of their losses. By the end of the day, the only two things that beat the broad market, everything else down. So energy eventually came down a little bit. Gold, but again, pairing some of those gains. Gold dropping down. And of course, bonds really finishing the day at the lows and finishing off. The only really news from an economic perspective was a consumer sentiment survey and it came down. So this was a revision. This is the middle of November. This is the preliminary for November, and you can see down from 100, but it's still very, very high number. So the economic surprise index is still very strong, but again, you can see, so the red line's the odds of only this December rate hike that's pretty much baked in the cake. So now we start looking at whether we get one more hike, which is this one, or 2 hikes, and you can see that the odds of 2 hikes are dropping. And so it's looking like, for now, we got December here in red, and the odds for one more by June is here. Still not, that's not above 60% yet. But when you combine this one and the 2 rate hikes, both of those add up to 20% or over 60%, because we're down here below 40. So there's decent odds we'll get another hike by next June, most likely just one. And we can see, despite the fact the economic indicators are very, very strong, there wasn't much on the calendar this week, but you can see next week, if I were to go look at next week's calendar, we got a lot. Look at all the red dots. Housing starts, Philly Fed, jobless claims, retail sales, petroleum report, CPI, PPI, and then on the green ones, the budget, the Empire State Manufacturing, business inventories, the Treasury International Capital, the housing, the home builder sentiment survey, import-export prices. A lot of news that's going to impact what happens here. And of course, some of those, again, the market sentiment is strongly bullish. The posture is bullish. Yes, there's a little short-term weakness right now, but there's not going to be any significant weakness unless there's a catalyst. And there was a little bit of a catalyst this week with that tax reform, this idea, that source that came out and said they're considering pushing it back to 2019. Could now that we're through earnings season, now the shift will be back to economic indicators and expectations. The Q4 GDP expectations are still, what are they, at 3.3% here, and they won't be updated until next Wednesday. So they're still pretty high, and they were at one point at 4.5%. But we also know that this always starts off high and ends up a lot lower. So, and we also know, there was the comment from Greenspan about the idea that we won't get to 3%. That he's not expecting a big dramatic drop in the markets like we saw in 2007, but he's also not expecting us to get to 3% economic growth either, because if we take a look at yields and inflation expectations, so here's the 5-year forward here, and you can see it's not going anywhere. It's continuing to go down, down, down. Here's a more up-to-date look at it, but still right around 2%. Off of the levels that we saw earlier this year when we were above 2%. So again, that's why, like the 10-year note, while it did have a strong upward move to 2.4%, looking like, unless we break through here, looking like the potential for a head and shoulders pattern here. So we'll see if this 2.4% has been a resistance in the past. Touched it here, came down, touched it here, came down, touched it here, came down. Closed, gapped up above it for 3 days, gapped back down below it, and then now we're touched it. So very important to see what happens on Monday, because again, this idea that economic growth, sentiment surveys are really, really bullish based on anticipation of fiscal reform, fiscal policies, but actual economic growth, as reflected in these forward inflation expectations rate and the yields here, they're all coming down, not just here but globally, and it's going to be hard for the market to maintain strong double-digit growth rates. They're going to be more like single-digit and probably low end of single-digit on an average basis. Of course, I've told you before, if you're expecting 2% over the next 10 years, there probably won't be a single year where you'll get 2%. You have some years above that, some years below that. But with what the Fed is doing with their policies is they're kind of shrinking that standard deviations down to where, instead of having 20% gains and 20% losses, it's, in the 5% gain and 5% loss, or 4% loss and 3%, you can see the numbers start to get smaller and smaller. I think that's what Greenspan's talking about. We just don't have the economic growth or the volatility to get those big kind of moves. So we're not going to, like the period from 2000 on, where we had very little average returns, but we also had big, bearish markets and big bullish markets. Most likely won't be the case now, because we're in a much different environment now. There's no bubble unless you count something like Bitcoin or cryptocurrencies or anything like that. Aside from that, there's no real insane bubbles like we saw in technology, where there was just crazy things happening in the dot-com world, or in real estate, where there was some crazy things happening in real estate. Right now, there's just no crazy things happening anywhere yet. But we also don't have the push, the growth, to continue at 8% plus, average rates here going forward. So that's going to affect how we manage portfolios. And I've asked you this before. If you knew that over the next 10 years, the market itself is going to only average 2% a year, how would you position your portfolios now to take advantage of that, to know that? Because that impacts the kind of things that we do. Are we as aggressive? Are we now less aggressive because of that? If you knew, from a certain period of time that there would be 10% a year growth on average over the next 10 years, then we'd say, okay, let's get aggressive. Let's get that return. 2%, different story. All right, let's take a look at how the sectors performed here. We'll look at this week first, and you can see real estate was the best performer, and consumer staples. Remember how consumer staples is just having a bad run of things, even through Monday. Monday was a down day, but from Monday going forward, you can see it was consumer staples world, and we're all just living in it. It had a really, really good end of the week, and by the end of today, all these consumer stocks, consumer discretionary and consumer staples up 1%. So that brings up this idea again that, okay, if you're going to, if the return expectations are low and implied correlations are low, which means, you would think that, okay, well, all this move in the passive investing and index funds, that everything's going to move up together. Well, you can see that's not the case. I mean, on a day like today, when the market was relatively flat, we had one sector that was up over 1%. We had another couple of sectors that were down more than 1%. Remember, the broad market can't drop 1% without a buy the dip, rip and roar, or go up 1% really, because there's not enough volatility. So it's flat, but not everything is flat. So that's what we're talking about. When these correlations are low, it was staples' turn. Another day it might be technology's turn still that's up there. On the other end of things, energy had a really, really good run lately, and it looks like it's giving back some of those gains here recently. Or to zoom out, you can see it had a really strong run for 2 weeks. And now giving some of that up. All right, well, let's go ahead and take a look at our trade idea of the day. And you can see on the screen we got Invidia, which had just had its earnings announcement here. And you can see the little green on the screen, the green arrow that we had after the market. And of course, the market loved it. At least loved the expectations going forward to the tune of 5% gain today. But again, what kind of moves do we expect to see? Low volatility environment. Now, this is a pretty good bullish stock. You can see its posture strongly bullish, just like the market. Near-term line had pulled back, bouncing off a new higher low point, rallying up higher. You can see long-term chart is easily strongly bullish here. Give it a second. There we go. I mean, look at that. The 50-day moving average crossed back up above, just barely, but crossed back above over here. What was that, back in 2015 at 22.5, and has been on a rip roar and ever since, and almost a 10 bagger. So it's obviously on a strong long-term trend. You can see today's move breaking out above an upper Bollinger Band, coming off of the middle here. So if there's any risk, we're not looking for a big move to the upside. We're more about risky about any kind of downside moves because of how bullish we are and how bullish the market is, and whether that's sustainable or not. So what we can do is we can say, okay, well, let's set up a trade as a debit spread trade, where in this case we'll sell that 225 strike, at that 30 to 40 delta. And then what we'll do, instead of buying the 220, which is not quite at the money, we'll buy one that is a little bit in the money. We'll buy the 215. So I've got a $10 wide spread here. But here's the difference. So what we're going to do now is we're going to sell another. So we have a debit of 436. So about 50-50 odds. But to cover that cost, I'm going to sell another 225 strike. Now I'm not covered on that one, right? I am. The debit spread is by itself is a defined risk trade. Now I've got an undefined risk trade because I have this this naked call on to the upside at 225. So now we'll take a look at that. You see, I had $1.05 credit. So we'll throw that on the Analyze tab, and this is what it looks like. So again, upside risk. You can see we don't get any potential any loss on expiration date, at least, until we get up to 236.03. That's way up there. Why is that so far up there? Well, remember, I've sold 2 calls. If we keep going now, I bought the 215 call. So if we keep going up and up and up to 236, that 215 call is going to keep making money. Now I've sold 2 of these calls, the 225 calls, and I've sold them for $10 total. So I'm making $10 in credit. That's going to get added to that strike, because if I go up above 225 by $1, then I lose $1, but I've made 10 from selling the 2 strikes. So that's why it gets added to 225 right here is where we want it to be. They expire worthless, and I get to keep all $10 in addition to what I make on the 215 call. But then we start getting above 225, I start losing some of that $10 to the point where there's my break-even price there. Once we get up to 236, now I start losing money. Well, 236 is way up there. Are we going to get, granted, of course, anything can happen, and this is on a strong trend, but we're just not in that environment right now where we're expecting big moves to the upside. We're more in the environment where there's potential bigger moves to the downside. At least you can see this is for a December expiration. By the end of the year, those last couple of weeks, there might be some upside potential there. And I've got plenty of room to work with. Remember, the 225 is the 30 to 40 delta, and the strike, the 236 break even is above the 235 strike, which is at a 22 delta. So you notice I've got an 80% chance of making something, because the reason why it's so high is I don't have any risk to the downside. This credit covers my risk to the downside, because remember, I bought the call. I lose money in that 215 call if we drop, but I've offset the cost of that call by selling these 2 calls. So as long as we stay below 225, as long as we stay anywhere below 225, you make money on this, because you sold those 2 for $10 each, or $10 total, so $10.50 total, 2 of these 525s. So you made 10. If we say anywhere between 225 below it, then the 225 calls expire. You get to keep all that $10.50. Now you paid $9.75 for that call. So depending upon where you finish there, if you finish below 215, it expires worthless. So you made the $10.50 on the 225s, you lost $9.75 on the 215. They all expire worthless below 215. I get to keep the $1.04 net credit. So that's why you notice $1.04 is my gain here this whole way. It doesn't matter how far it drops. So we've taken the risk away on the downside. There's no break even over here. We put it up over here. And that's okay, because again, we're not expecting big upside moves. We're more worried about the downside moves. So we take the risk away to the downside. We give ourselves some potential reward. So you notice I'm risking, we can get up here and you can see my maximum gain is about $1,000. Well, to lose $1,000, we'd have to go all the way up to 246 from where we're at right now at 216. So that's where, by that point, is where we'd get a 1-to-1 reward to risk ratio. So this is what's called that back ratio spread, where essentially it's a debit spread that we're going to sell a second option at that short strike to cover the cost of the debit spread. In this case, it's a long call debit spread, which is bullish, and so we're going to sell another short call to cover that debit spread to take away the downside risk, because we're bullish. We want it to go up, but in case it doesn't, we're going to cover that downside risk and the cost of that, because there's pluses and minuses to every option strategy. So the benefit to this strategy is you take away the risk to the downside. The cost of the strategy is you now do have a break even to the upside. Because remember, with just a straight debit spread, there's a line right here at maximum gain. So now, because we sold that second strike, we've taken away that maximum gain, and this line now comes down to a break even. Because again, you start losing. You lose all that. The 225 will lose money, and you've got $10 a buffer there of what you sold. Once you get past that buffer, then you start losing money, and that starts offsetting what you're making on that 215 call. So in summary, the markets continue to be strongly bullish, but we do have some short-term weakness. There was that kind of unexpected news item that produced a brief couple of hours of risk, of volatility, that the buy the dippers came in and completely eradicated. But you can see the potential for something unexpected. And now we're through earnings. Next week we're going to have a lot of economic indicators. We might get another day of weakness. Mondays tend to be really quiet on the economic data front, so don't be surprised if we get another small down day, at least for the large cap indexes, before we start up. But don't, again, any near-term bounce, and we're not expecting to be too big because of how high that market sentiment is. And so today's trade idea says, okay, well, let's take advantage of the trend, of the posture of a stock that's in an outperforming industry, a strong stock, and we will we'll say, okay, if return expectations are lower to the upside, we'll throw our risk up there, way up there, take away the risk to the downside, and throw that risk way up to the upside, and give ourselves a potential return if we go up a little bit. And so that's the strategy that we can take advantage of in this kind of market environment that we're in right now. One more brief disclosure about that trade idea too is it is a debit spread, which is risk defined, plus a short naked call, which is not risk defined. So know that's a risky strategy, and it requires a margin to be able to cover, because there's no maximum loss on a short naked call. So it requires a pretty large margin to be able to get into that. Might be a little bit more capital intensive than what you may be used to when you're trading call verticals. So again, thank you very much for watching. Like this video down below in the YouTube section. Comment, subscribe to the channel, like it on Twitter, retweet it. The more you do those things, the more people know about it, the more you spread the word. So thank you again. Have a great weekend, everybody. We'll see you all on Monday.